This is question 4 of paper 1. We are doing part D and part E, where we need to prepare the trade receivables control account as well as the trade payables control account. So for that, we need to decide which of these figures will go into which accounts. Here we have the opening balance on 1st March, so we know that this is the balance brought down. First one, purchase goods using cash. You do not record cash purchases or cash sales in either of the accounts, because in the first place, if you were to record cash purchases or cash sales, then there wouldn't be a need for a trade payable or a trade receivable account, right? These accounts are only for on credit terms. Okay, so checks received from credit customers, so trade receivable. Goods returned by credit customers, trade receivable. Discount received, we only receive discounts from our suppliers, so trade payable. Credit sales is your trade receivable. Checks paid to the credit suppliers is your trade payable. Credit purchases, you buy from your suppliers, so trade payable. Interest charged by suppliers, trade payable. Contra between the sales and purchases ledger, so this will affect both your trade payable as well as your trade receivable. And of course, write-off of trade receivables, very straightforward, trade receivable account. Okay, so now that we have decided which numbers will go into which account, we can prepare our accounts. So for the first one, trade receivable account, of course there is a balance brought down, so don't forget on March 1st, $34,098 debit. Okay, now the business had the following transactions for March 2019, which means the following dates has to be the last day of the month. Alright, so for the first one, if you go back to your question paper, the first one is 4090. So with each transaction, ask yourself, does it increase or decrease the trade receivable account? So checks received from credit customers. Customer is paying you, so they will owe you less. So therefore, it will be on the credit column. Alright, so you will credit your trade receivables, debit your cash at bank. The next one, goods returned by credit customers. So when customers return you goods, they owe you less. That's why they are on the credit side. So you will debit your sales returns, credit your trade receivables. Okay, and of course, credit sales. Credit sales is what we call sales revenue. You cannot just write credit sales because credit sales is not an account. Alright, so you have to rewrite it as sales revenue. When you sell goods to your trade receivables, they will owe you more. So therefore, debit your trade receivables, credit your sales revenue. Okay, and then of course you have a contra entry, right? You have to offset, and we will offset by placing the amount that will decrease the balance in the account. In this case, it is on the credit column. Okay, 1,800. And of course, there is a write-off for trade receivables. When we write off a trade receivable, our trade receivables decreases. Therefore, it is on the credit side. And this would be your allowance for impairment of trade receivables. You can never write impairment of trade receivables. Okay? And then of course, you will bring down the balance to the following month on April the 1st. Let us go on now to the trade payables account. So same thing, you will search for an opening balance. In this case, on March 1st, there is an opening balance of $26,780. And then when you receive a discount, you ask yourself, when you receive a discount, do you owe your payable less or more? Okay, so once you have a discount, of course, you owe them less. Therefore, you will debit your trade payable account. When you pay off your suppliers, you owe them lesser. All right, you will debit your trade payables and credit your cash at bank. Next one, interest expense. All right, the interest is charged by your suppliers because the business did not pay on time. All right, so if you have to pay interest, therefore that is an expense. That means you owe your supplier more, $100 more. All right, so debit your interest expense and you credit your trade payables. Okay, inventory, because this is your credit purchases, right? So when you purchase inventory on credit, you will have to debit your inventory and credit your trade payable. So your liability in your trade payable will increase by $56,625. And then you have a contra entry. Once again, we have to reduce the amount that is owing to the trade payable, so we place them on the debit side, right? And then you will have a balance brought down to the next month.